Hey there, stock market warriors. Ever wonder how to spot a company that's drowning in debt? It's like watching your buddy max out his credit cards at the casino. Sure, he's having a blast now, but we all know how that story ends. So let's dive into the world of corporate debt and learn how to avoid the financial quicksand that can suck your portfolio dry. Now, I've seen my fair share of companies go belly up because they bit off more debt than they could chew. It's like watching a train wreck in slow motion. And trust me, you don't want your hard-earned cash on that ride. So, how do you know when a stock's got too much debt? It's not rocket science, folks, but it does take a bit of detective work. First off, let's talk about why too much debt is bad news for stocks. It's like trying to run a marathon with a piano strapped to your back. Sure, you might make it a few miles, but eventually, that weight's gonna drag you down. Companies with heavy debt loads are spending their cash on interest payments instead of growing the business. Kind of sounds like the government, right? Who would ever invest in government and expect to make money? When tough economic times hit, who falters first? Those with high debt. Now, here's a little trick I picked up along the way. The debt-to-equity ratio. It's like a financial X-ray that shows you how much a company owes, compared to what it owns. It divides the company's total debt by the total equity of the company. If this number's creeping up, like your waistline after Thanksgiving dinner, it's time to take a step back. A high ratio means the company's leveraged to the hilt, and that's about as stable as a Jenga tower in an earthquake. What is a high ratio? Generally, when I see anything over 2, I start to be concerned. However, it does depend on the type of business it is, as some stocks have a large capital requirement to operate their business. So, naturally will have a lot of debt. So it's also about, can they manage the debt? But hold on, we're not done yet. I've got another ace up my sleeve, the Altman Z-Score. Sounds fancy, right? It's actually a nifty little formula that predicts how likely a company is to go bankrupt. Combine this with the debt-to-equity ratio, and you've got yourself a 1-2 punch for spotting financial trouble from a mile away. Let me break it down for you. The Z-Score looks at a bunch of financial ratios and spits out a number. If it's below 1.8, that company's on thin ice. Between 1.8 and 3, they're in the danger zone. Above 3, you're looking at a financial fortress. Now pair that with a low debt-to-equity ratio, and you might just have found yourself a winner. How are you doing there? You better not be falling asleep. This is good stuff I am giving you here. Now, we are almost done. Pay attention, because the rest is easy. By the way, how do you like the background music I picked? I really like it. Hopefully you do too. It's nice and upbeat. Kind of the vibe I'm going for here. Anywho, let's get back to the content gold I am trying to give you here. I remember this one time, I was eyeing a tech stock that looked hotter than a jalapeno. Flashy product. Cool CEO. The works. But when I dug into the numbers, their debt-to-equity ratio was through the roof. And their Z-score was lower than my golf handicap. I passed faster than you can say, chapter 11. And sure enough, a year later, they were yesterday's news. Now, don't get me wrong, debt isn't always the boogeyman. Sometimes companies take on debt to fuel growth, like borrowing to build a new factory, or buy out a competitor. It's all about balance. You want a company that's using debt smartly, not one that's up to its eyeballs in IOUs. Here is a pro tip. Look for companies with debt-to-equity ratios below 1, and Z-scores above 3. It's like finding a unicorn in the stock market. Rare, but oh so valuable. These are the companies that can weather economic storms and come out stronger on the other side. Remember folks, investing is a marathon, not a sprint. Don't fall for those get-rich-quick schemes or penny stocks promising the moon. I've been down that road, and let me tell you, it leads straight to Brokeville. Stick to solid companies with strong financials and manageable debt. It might not be as exciting as betting on the latest meme stock, but your portfolio will thank you in the long run. So next time you're sizing up a stock, put on your detective hat and follow the money trail. Look at that debt-to-equity ratio, crunch the Z-score numbers, and ask yourself, is this company built on a solid foundation, or is it a house of cards waiting to collapse? Do your homework, trust your gut, and remember, in the stock market, boring can be beautiful. Now go out there and find those hidden gems. The company's so rock solid they'd survive a zombie apocalypse. Your future self will be raising a glass to your financial savvy while lounging on a beach somewhere, all because you learned to spot the difference between good debt and a ticking time bomb. Happy investing, and may your portfolio always be in the green.